top line growth of 7.6%, operating margin improvement of over 200 basis points, so great operating leverage across the business. We're seeing strong performance across the business. We're seeing a strong demand for our data through new AI distribution channels. And this is a business that does generate a lot of cash flow. So we are in a very healthy, strong position to take advantage of some of the dislocation in the shares. So we have announced a record buyback this morning, £3 billion, largest buyback we've ever done. But what that does is that it allows us to, as I said, return surplus capital to shareholders, address some of the dislocation in the stock, but also maintain strategic flexibility for the business. We're not over-levering the business.
Is it been frustrating for you watching what's been happening to the share price, given the strength in the business that you're pointing to in these earnings, to see your shares hit to the extent that they have been, along with others in the sector?
I think for us, the focus is on executing. The focus is on delivering. The stock price, the markets broadly will do what the markets will do. Sometimes they seem very rational. Sometimes there seems to be some sort of indiscriminate activity and waves of either buying or selling in different sectors. From our perspective, we focus on delivering for our shareholders, executing for our customers.
In terms of the pace of the financial markets data subscriptions, this is a big focus for the business. You mentioned it in the first answer that you gave us just there. Is that actually improving in terms of the data subscriptions model that you increasingly want to go to?
So a couple ways to think about that. If you look at our annual subscription value growth metric, that we are at 5.9%, which is higher than what the market expected. We also are seeing, as I mentioned earlier, in terms of distribution of our data through new distribution channels with our AI partners, and these are the likes of Claude at Anthropic and ChatGPT with OpenAI, and we have a number of similar partnerships with others like Databricks and Snowflake. We just turned these on a couple months ago. This is a new distribution channel for us and for the industry, and we're seeing very strong demand for accessing our data through these channels. And again, to be clear, if you are a user of our data, or you want to access our data through these channels, you have to have a direct license with LSEG. But what's really interesting about this is that we're seeing both existing customers accessing our data through these new channels. We're seeing some new users at existing customers trying to access our data through these new channels, which is great. And then we're also seeing new customers looking to access our data through these new channels. So from our perspective, and this is playing out in the numbers, we're seeing the AI capabilities and partnerships as an expansion of our addressable market, as an expansion of distribution for us.
And David, I should say at this point, the parent company of Bloomberg News competes with LSEG to provide news trading services and data to the financial industry as well. But given what you've just talked about and the development of that business, does that not add strength to the argument that perhaps you should consider spinning off the stock exchange business?
So we have a core strategic approach that includes serving our customers across the trade life cycle. So that's pre-trade, trade, and post-trade, on a global basis and across asset classes. The London Stock Exchange is a core part of that. It is a primary capital execution venue. It also creates data for us to provide to our users and to our customers. And we have zero intention of selling off that business.
Zero intention?
Zero intention.
Okay, that's despite the plunge in listings that LSEG saw last year, not in the top 20 global IPO destinations. Also,
let me just...
Yeah, you want to clarify?
Well, so if you use that metric, that's for the first 3 quarters of last year. If you look at last year in the fourth quarter, the IPO window opened, and as you know, the IPO window closes sometimes and it opens sometimes. IPOs in London last year, when you include the fourth quarter, it was the best year since 2021. We also saw very healthy activity in the secondary market in terms of secondary raises, and that was close to £20 billion. So the market continues to be very healthy, lots of access to capital, a strong pipeline for this year.
How much pressure are you under from Elliott Management? the share buyback is not as big as Bloomberg was reporting that Elliott Management was pushing for earlier this month. And the question of selling off or divesting the stock exchange business is also perhaps part of the thinking about Elliott. How much pressure are you under from them for changes?
So as my kids like to say, pressure is for Tyres. We have lots of shareholders. Some of them are more vocal than others. We listen to all of our shareholders. We're happy to engage with our shareholders. Some of them communicate very quietly and have great ideas.
Are you in discussions with Elliott Management?
We have had discussions with Elliott, but we talk to all of our shareholders. We've had a lot of discussions with our shareholders, especially over the past couple of weeks since a lot of this has been public. So I would say there are very different views amongst many of our shareholders. Some are of the view that the strategic approach we've been taking over the last several years is very much on target and that we have been executing very well. And I think the numbers that we put out this morning reflect that. Again, strong, consistent top-line growth, strong margin improvement, strong allocation of capital. Other shareholders can have different views, and that's fine. We try to listen to all of our shareholders. We can't always make all of them happy.